This is just a sample of the audiobook. To get the complete audiobook, access the link posted in the first comment.
The purpose of this audiobook is to supply, in a form suitable for laymen, guidance in the adoption and execution of an investment policy. Comparatively little will be said here about the technique of analyzing securities. Attention will be paid chiefly to investment principles and investors' attitudes. We shall, however, provide a number of condensed comparisons of specific securities, chiefly in pairs appearing side by side in the New York Stock Exchange list, in order to bring home in concrete fashion the important elements involved in specific choices of common stocks. But much of our space will be devoted to the historical patterns of financial markets, in some cases running back over many decades. To invest intelligently in securities, one should be forearmed with an adequate knowledge of how the various types of bonds and stocks have actually behaved under varying conditions, some of which at least one is likely to meet again in one's own experience. No statement is more true and better applicable to Wall Street than the famous warning of Santayana. Those who do not remember the past are condemned to repeat it. Our text is directed to investors as distinguished from speculators, and our first task will be to clarify and emphasize this now all but forgotten distinction. We may say at the outset that this is not a how to make a million book. There are no sure and easy paths to riches on Wall Street, or anywhere else. It may be well to point up what we have just said by a bit of financial history, especially since there's more than one moral to be drawn from it. In the climactic year 1929, John J. Raskob, a most important figure nationally as well as on Wall Street, extolled the blessings of capitalism in an article in the Ladies' Home Journal, entitled, "Everybody Ought to Be Rich." His thesis was that savings of only $15 per month invested in good common stocks, with dividends reinvested, would produce an estate of $80,000 in 20 years, against total contributions of only $3,600. If the General Motors tycoon was right, this was indeed a simple road to riches. How nearly right was he? Our rough calculation, based on assumed investment in the 30 stocks making up the Dow Jones Industrial Average, DJIA, indicates that if Raskob's prescription had been followed during 1929 through 1948, the investors' holdings at the beginning of 1949 would have been worth about $8,500. This is a far cry from the great man's promise of $80,000, and it shows how little reliance can be placed on such optimistic forecasts and assurances. But as an aside, we should remark that the return actually realized by the 20-year operation would have been better than 8% compounded annually. And this despite the fact that the investor would have begun his purchases with the DJIA at 300 and ended with a valuation based on the 1948 closing level of 177. This record may be regarded as a persuasive argument for the principle of regular monthly purchases of strong common stocks, through thick and thin, a program known as dollar cost averaging. Since our audiobook is not addressed to speculators, it is not meant for those who trade in the market. Most of these people are guided by charts or other largely mechanical means of determining the right moments to buy and sell.